coming in from the Asian markets. Let's watch out for that. But some of the big global stories, let's talk about that now. The Federal Reserve has held the interest rate steady at 3.5 to 3.75%, but the real headline is sharp split within the central bank. In what could be Jerome Powell's final meeting as the chair, and the FOMC delivered an 8-4 vote, the highest level of dissent since 1992. Now, the divide reflects a growing policy dilemma. On one side, some members pushed for a rate cut, pointing to signs of softening labor market and slowing growth. On the other side, several policymakers pushed back even against signaling future easing, warning that inflation remains stubbornly above 3% and risk becoming entrenched. At the center of the disagreement was the Fed's forward guidance, a key line suggesting potential future rate adjustments drew opposition, with dissenters arguing it signals premature easing. Powell, meanwhile, indicated he may continue on the board beyond his chair term as an integral investigation continues, adding another layer of uncertainty to the leadership transition. Let's go across and listen into that.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board.
And big win for Kevin Warsh, U.S. President Donald Trump's pick for the U.S. Fed chairman position as he cleared a key procedural hurdle. The development opens path for him to succeed Jerome Powell in the coming weeks.
And along with that, let's get back home. And in a conversation with FICCI President Anant Goenka, Columbia University professor Jeffrey Sachs has underlined the impact of West Asia war on and how India can aid in stopping the war. He has also elaborated his take on UAE exiting OPEC. Let's go across and listen in.
At some point, a shooting war could easily start again in that view. If Trump were to do something even more disastrous, which Israel is urging by the day, which is a resumption of actual fighting, I would say we would be in a catastrophe, not just a dire crisis, but a worldwide catastrophe. Because at least as I understand it, and nobody has disabused me or others of this view of the thought, Iran has credible deterrence in the form of being able to blow up critical infrastructure in the Gulf in a very short period of time. I have one theory which I have propounded from the start, which is that Trump listens to three people in the world, and that is your Prime Minister, President Putin, and President Xi, because there are four superpowers in the world: the United States, China, India, Russia. And Trump wants to be in that group. And if the other three say clearly to him, publicly or privately, Donald, stop. Stop now. Don't even think about resuming the military. That would be a disastrous situation. I think he would listen. And I think it's extremely important to convey that message. With OPEC, it's just about the opposite of what they should do. And Here I did have detailed discussions with the Emirates officials over the last few years. The issue is basically the following. The world will move away from oil and gas in the next quarter century, faster than we know now. This is because the climate crisis is very bad, and it's going to get a lot worse fast, and India, unfortunately, is going to be in the front line of feeling it.
And well, let's talk about the earnings then. Samsung has reported a blockbuster quarter with the operating profit surging over eightfold, beating the estimates. The jump was driven by strong demand for AI-linked memory chips and a global supply crunch that pushed the prices up. Revenue also hit a record, rising nearly 70% on a year-on-year basis.
And moving on to Alphabet then, because Alphabet delivered a strong Q1, beating the revenue estimates as its cloud business surged. And Google Cloud crossed $20 billion in revenue, growing 63% on a YoY basis, driven by enterprise AI demand. Now, the company also raised its 2026 capex guidance to as much as $190 billion and signaled even higher spending in 2027 as it ramps up AI infrastructure.
And Microsoft delivered a strong quarter, beating estimates on both revenue and profit, with Azure cloud growth coming in above expectations. AI continues to drive the momentum with over 20 million paid seats for Microsoft 365 Copilot, and annualized AI revenue that crossed $37 billion. However, the guidance disappointed slightly, with margins expected to narrow. The bigger headline is that Microsoft now sees FY26 capex at $190 billion.
And Amazon reported a strong Q1, beating the estimates on both revenue and profit, with AWS cloud growth accelerating to 28% YoY. Advertising also came in ahead of the expectations, supporting the overall performance. However, heavy AI and infrastructure investments continue to weigh on cash flows, with free cash flow sharply lower. The company remains bullish on long-term growth, backed by strong cloud demand and expanding AI capabilities.
And Meta Platforms raises 2026 capex guidance to as much as $145 billion as it ramps up the AI investments, but the stock slipped amid concerns over rising costs and legal risks. The company warned of potential material loss from growing global scrutiny over youth safety on social media. While revenue beat the expectations, investor sentiment was weighed down by higher spending and regulatory overhang.
And Anthropic is in talks to raise fresh funding at a massive $900 billion valuation, potentially overtaking OpenAI as the world's most valuable AI firm. This surge comes as Anthropic's annualized revenue hits $30 billion, driven by strong demand for its Claude model. The fundraising push reflects the escalating race for AI dominance, with capital needed to scale compute and infrastructure for next-generation models.
And let's talk about politics back home then. The